without further ado, let's just get right into it. So let's talk about what we're going to cover today. We're going to cover unemployment, Fed decisions. We're going to cover the election, housing, inflation, stock market indexes, and finally some updates to the virus and the vaccine. And I'm going to cover a couple things that I've been getting some questions on by emails about annuities and caps and why I have put that kind of on my needed change list. So let's just jump into it real quickly. If you haven't attended any of these broadcasts in the past, this is what we call an economic mapping, where we take all the different possibilities. We then create the probability mapping or algorithm to figure out what the potential for any of these things are to happen. So if you take a look, you'll see here that we have made some adjustments to our algorithm since February, March of 2020. And one of those changes was what I would consider the crash of the real estate. And originally what we thought is that because of the rent moratorium, the forbearance on the foreclosures and mortgage payments, that we would see a real estate crash sometime in February, March of 2021. We have now pushed that into the summer, July, August, even September of 2021. Again, right now there's 8.4 million mortgages that are in forbearance. I want to remind everybody about something. If we just remember history and we go back to the Great Recession, and do you remember the real estate companies, the real estate promoters, the real estate investors? They all came back out and said, back then, they said, don't worry about all these, unsubstantiated mortgages. Don't worry about the boom in the real estate. Real estate's always going to be good. It will, but there are going to be times in history where we can look at buying because the price is so good. I really believe that next summer will be that, because if you remember back in 2006, 2007, they all said that the real estate was going to always continue going up. I sounded the alarms back then, just saying I don't understand how they can figure that, because you've got all these people, you have people making $30,000, $40,000 a year buying $1 million house because they can't substantiate their application of their income. I'm seeing that same dynamic right now, and I am fully anticipating huge real estate crash. Now again, I'm not going to say that the real estate is going to crash all over the country. It will crash in certain areas, primarily Los Angeles, Chicago, New York, Miami, those places where a lot of the virus has hit, a lot of people moved out. The economic base itself has changed within those places. And then if you add on to that the mortgage forbearance that is coming due, and there's no plan right now on how to pay that off, then we do see that the dynamics and the fundamentals will cause that crash. Now let's go into, I do believe that real estate will rebound, and it will rebound within about a year or so. So there is that short period of timing that we can jump in. Some of you remember when the 2008 mortgage crash happened, you could go buy a $300,000 house for $75,000 to $100,000. And sometimes they were giving them away. And so again, this is another buying opportunity. We know of people that worked in the Florida market and in the Los Angeles market and in the Las Vegas market. They bought hundreds of homes for just a few $1,000,000. And now they're sitting on $40, $50 million. So again, these are big opportunities that are coming up. And again, a lot of that is dependent upon interest rates, the political and tax environment, and how many people are employed. Well, we already made this assumption that we're going into phase 2 and then soon to be into phase 3 into 2021. And a lot of what happens with the real estate market and the stock market is going to be based upon employment and the ability for people to buy homes and justify the mortgages, because it's a lot harder to get. So we're calling the circle of real estate volatility to be in the summer of next year. Now let's talk about the taxes. I changed version 4 about a month ago, early September, when Biden and his administration came out with their tax plan. I have made some major adjustments to this economic mapping because I think it's going to make a big difference. So the stock market under Biden, I think, is going to increase quite drastically, but then based upon those tax changes, we will see a very quick drop. If somebody asked me off the cuff, what do you think? I think that if Biden gets in and the House and Senate is controlled by the Democrats, we're going to see that $3 trillion CARES or a HEROES Act that Pelosi proposed back in May. And I also think that we'll see a 30% increase in the stock market, but easily a 20% pullback. Again, that's not only controlled by just the economics of it, but it's also controlled by the institutions and the hedge funds that are playing this game against you. Now, if Trump gets in, I do see that there has to be some tax changes to cover this $7 trillion, but they're not going to be as draconian as the Biden, because there's no plan to undo the Trump tax reform. There's no plan to increase regulations. There's no plan to increase corporate tax and make us non-competitive again with the U.S. So again, these things are all things that are very, very critical in this election. And again, we'll have a better idea in about a week or so. Now, what I do see is that if Trump is elected, we will probably see around a 10 to 15% increase in the stock market, because again, if the Republicans get in, or at least if there is a stimulus package, and we know that the delay in the stimulus package is mainly due to politics. Once the election is over, I'm fully confident that a stimulus package will get through. It'll probably be more in the $1.6 to $1.8 trillion number versus the $3 trillion number, which does not give as much of a pump up to the stock market, but it also does not give as much of a crash. Again, I am still anticipating, and you're seeing it, we changed this back in the beginning of September to version 4. And I said, expect this massive, massive volatility until the election is over. We see it. The stock market goes up 8%, down 10, up 12, down 10. I mean, we've seen this just within 60 days. It's some of the wildest volatility in many, many decades. So again, the stimulus relief really has to do, and the hang-up has to do with the Democrats. Well, I shouldn't say that. It's not all the Democrats. It's primarily Pelosi, Schumer, and some of those Democrats that want to bail out some of the bankrupt states, their pension plans, add on a lot of things that really just have nothing to do with a virus stimulus or a virus relief package, but they're using it as leverage. So again, they're in that stimulus package when it's released, depending upon who wins and what side of, what happens to Congress too. PPP is going to be there. Mortgage forbearance should be at least worked out. Stimulus check, how much, if anything, will everybody get? What will the unemployment be? How are they going to cover student loans? And then some of the other ones, like you see on your screen there, the state pension bailouts and the state reserve funds, okay? Again, but the economic growth of this country and the faster recovery is not going to be dependent upon the size of the stimulus package. It will be dependent upon where that stimulus package is dispersed. If it's dispersed in concentrations, like for state pension plans, then it won't probably have as much of a relief as what we think, but it will still have as big of a tax cost as the stimulus package level is. So that's a very dangerous thing. So here's some good news on the economic outcome, or the economic unemployment. We're down to 751,000. I know that sounds staggering for the last week, but considering that we were over a million for a while, and then we dumped under 800,000. So we had a decrease of 40% or 40,000 new jobless claims. And here's the greatest thing. We're down now under 5.5% unemployment, down to 5.3. And it's the third week that we've decreased unemployment. Vaccine update. Well, we got 35 vaccines in the works right now. We've got 14 companies in phase 2, 11 companies in phase 3. 6 companies now approved for limited use. And then there's 1 company approved for emergency use with adults and children over 12 years old. And let's talk about that for a little bit. So we have Pfizer and BioNTech, however you want to pronounce that. They've now just released that they're going to have a 3-week pushback. That still puts us in November, which was our target date. We have Gilead Pharmaceuticals. They're now produced over 70 million doses over the last few months and they're ready for distribution. Moderna is 2 to 3 weeks away from the approval. They're expecting a November to December release. And now AstraZeneca has just released yesterday that they will be ready to release the vaccine in their limited use in December. So this is what we originally mapped out in our algorithm. We estimated that with the fast track program that the government put out, that the FDA, along with these companies, along with billions and billions of dollars that the federal government has funded into this research, we thought that it would happen towards the end of the year. That means that the first quarter of next year looks to be very, very positive. Things like reopening. We just saw that the Las Vegas fireworks were canceled. We've seen that Sundance Film Festival has been, on limited use. All these big events that we're also used to and should be grateful that we have them now. And hopefully we are very grateful and we'll recognize how grateful we should have been. Now we'll start to see some of these things come back into light and hopefully life getting back to normal. But as I said at the beginning of this, when we started these broadcasts 8-9 months ago, I estimated that this is going to be long-term economic and human damage, not to mention all the people that have gotten sick. And now we know that there is long-term brain damage, there is long-term organ damage, there's actually changes in the DNA that the virus creates. So it's that there's the health issues that we have to deal with long-term. We also now have to deal with what we were so worried about with all these massive lockdowns, is the psychological effect. We're now told that children, because of these massive lockdowns, will be 1 year in social and mental development behind what kids that didn't have to go through this would have been. We're now seeing suicides at 400%. They haven't been this high since the 60s and 70s. So we're seeing massive, massive depression, massive suicides, narcotic use is up, violent crime is up. All these things that we said that when you lock down humans and you take away their economic ability in certain cities to go out and earn money and have a decent life, it's going to have an effect. I'm not saying that we had a choice in certain places, but it's going to have an effect. And these are things that also have to be considered as to how they affect the financial markets, health insurance, Social Security, all these things that we deal with. They're not just the end math. We have to look at, like a ship captain, is the storm going to hit us? And can we reroute around that storm? And I think that there is a longer term storm coming that we have to be prepared for. Not much change with the Feds. Again, we've talked about this. Fed Chairman Powell's got 15 months left. There's not much left on what they can do from the Treasury standpoint and the FOMC. This is all really going to be based upon the stimulus package. And this is why Powell has pleaded with both sides of the aisle to get this thing straightened out. He says that there's about 2 to 3 years of economic recovery. I would completely agree with that. 4 years until an anticipated interest increase. But I want to bring to light, he only has now actually 14 and a half months left on his term. So this means that if the Democrats do a clean sweep, then he might get replaced. So we're looking at something completely different. Better inflationary recognition and remodeling the calculation methods is what they've done. So this really is going to have an effect on annuities and bonds and making sure that you are keeping up with or at least beating inflation. Now I'm going to go off on a little tangent right now because a lot of people have emailed me in because I've kind of brushed over about these annuity caps. And I've had a bunch of people ask me, can you explain that in better detail? So what an equity indexed annuity is, it's a pretty simple concept. What you do is when you invest the money with an annuity company, here's what they do. They take about 95% of your money and they buy bonds. Now, some of those bonds are short term, some of them are intermediate and long term. And what they do is they take the bond interest. Now, let's just presume they buy a 30-year bond, and let's just presume they get 3 or 4% interest right now. And what they're going to do is they're going to take a percentage of that interest, and they're going to keep that for their profit. So maybe they keep 0.5% to 1%. So maybe they have 2% left over. What they're going to do with that bond interest is they're going to go and buy options on stock markets. Now, you get to usually pick what indexes they choose. You could pick the Russell 2000, the Wilshire 5000. You could pick the S&P 500, the Dow Jones Industrial 30. There's all kinds of different indexes that you can choose from. And the way that the option works is when they buy the option, an option says that, let's just say that the Dow Jones is at 26,000 today. And let's say further that if they buy the option, and let's say that you have a 1-year option. So if the Dow Jones is above 26,000 in a year from now, well then whatever that's up by, that's your gain limited by whatever your cap is. So let's use an example. Let's say that they're going to buy an option on the Dow Jones Industrial Index at, say, 26,000. And it's a 1-year option index. Next year, if the index is up by 10%, the Dow Jones is up by 10%, you could make up to 10% if you had an unlimited cap. Now, let's talk about what happens, and I'm going to talk about why these caps are so important. Now, let's talk about what happens if the stock market drops. Well, your money is not actually invested in the stock market. Your money is invested in these government bonds. So the up or down, the down, I should say, of the stock market is irrelevant to the safety of your principal. Why? You don't have it in the stock market. All they're doing is they're taking the interest from those bonds and they're buying options on the indexes. So let's say that the Dow Jones drops from 26,000 to 16,000, 30-40% loss. What effect does that have on your annuity? It just means for that year, you may not earn any return, but your principal would stay exactly the same. Now, why is that important? Well, when you're retired, we've always talked about the 3 buckets. And in bucket 1, you always want to make sure that you have a secure, low volatile distribution bucket. That can be an annuity. Now, for most of you that know, I put a stop on any annuities inside of our planning system from the end of 2016. So for 2017, 18, 19, and just up until about 3 to 4 months ago, we would not use annuities. And one of the reasons is because of the caps. So in 2016, annuity companies pretty much categorically came out with a cap. As a matter of fact, if you go onto the YouTube channel, you'll see a video that I did back in February, March about being aware of people that were selling annuities back then, even in February, March. But right around August, September, we started to see a complete change in the tide of what these annuity companies were willing to offer in the upside of the caps. And so that cap is the most important part, in my opinion, of the annuity. It's not the surrender period. It's not the rider, because the rider is a way that annuity agents sell annuities, and a lot of times they mislead people to believing that they're getting a 6 or 7% rate of return. It's not a 6 or 7% rate of return. It's a 6 or 7% distribution. And so you might have a 6% distribution rate on your annuity, but your annuity may only make 1%. So that means that 6% or 5% of your annuity that's giving you money, it's just distributing your own money to you. Okay, that Ponzi scheme, right? Same concept. So again, or Social Security, right? Same idea. So again, in February, March, when I said, listen, be very, very careful of these, August, September, I changed my tune because they changed the caps. So now let's talk about the caps, and I'm actually going to give you an example. So hopefully that makes sense, how these equity index annuities work and what those caps are. So again, if the market drops 30-40%, it's not going to affect your principal at all. You've still got what you had in there from the year before, but you just don't earn anything. But now let's go back to that example that I gave you, that if, let's say, you had a 12% rate of return on the market and your cap was 8%, that 8% gets locked in. So if you have 100,000 and you have a 12% gain in the index that you choose and you have an 8% cap, At the end of the year, you have $108,000. Now, setting aside fees or things that I'm not going to get into here today with my broadcast, but assuming you don't have fees on that account, you now have $108,000, and that's locked in. All right, now what happens if you only have a cap of 2.5%? And this is what I'm talking about. Many companies have not changed their caps, which means that while some companies that we noticed in August and September started changing caps, a lot of them did not. I know the list of them because we have research software that figures it out, but a lot of these companies are still down in the 2.5%, 2.75% cap. How does that work? Well, now let's say that the stock market goes up by 12%, but let's say you have a cap of 2.5%. Well, you only get 2.5%. You don't get the full stock market rate of return. You only get the 2.5%. Now, that 2.5% still gets locked into a new base. But now we make the presumption in these concepts that the market goes up 12% per year. It doesn't work like that, which you're going to see in just a minute. Usually the market, on average, will go up 2 out of every 3 years, and once there'll be a loss. And so if we make that presumption, let's say that year 1, the market goes up by 12%, and year 2, the market goes down by -20%, and then year 3, the market goes up by 12%. Well, the way it works is if you have an 8% cap, that's going to give you 4% for 3 years, right? Because you earn 8% the first, 0 the second. Remember, you don't take a loss when the stock market loses. You just don't actually have a return. And then you make 8% the third year. So if you take the 16% divided by 3 years, you've made 4% per year, right? Now, if you take the 2.5% cap, same situation, now you're only making 1.66% per year. The enemy is inflation. Again, if you have 4% inflation, a 2.5% cap is going to lose you 7% over 3 years versus an 8% cap, which is going to cover inflation, and you're going to maybe break even, maybe make a little bit, but at least you're not going backwards, and that's one of the keys. And you can see here in the illustration that I'll bring up here, look in the top right, let me just find my little, if you look here what we're circling, look at this. 2017, the market was up 21%. 2018, the market was down 4.38, and then in 2019, the stock market went up by 31%. So let's bring our attention over to what's happening right now with the S&P market. So I'm going to switch gears a little bit because I wanted to cover what it means to have a limited cap on an annuity or a higher cap that you have the chance of breaking even with inflation. Now, why didn't I sound the alarm bells before this? I did. If you watch all the videos that I did on annuities, I kept saying if you have a 2.5% cap, you got a problem. But it not nearly as big as right now because of what has changed with inflation. Again, the Feds have completely changed the way that they're going to calculate inflation. We can anticipate a much higher, if not doubling, of inflation. It was only about 2% before. So if it was 2%, you had a 2.75% cap on your annuity. You had the ability or potential to actually be ahead, but not anymore. That's why I'm firing off the alarms. Hey, you got to be really careful if you've got one of these older annuities. Okay, so let's take a look at the stock market. So when we got into this year, right, here's the beginning of the year, and look at where we are right now. Here's our baseline. Right now we are, and you can see this here, positive 0.08. Now, we were as high as 6.5% up in this range, but again, as I stated in my economic mapping, we could anticipate, a lot of volatility during this election time. And again, a lot of what's going to happen with the stimulus package is a big number. Now, I want to bring your attention back to something. I just noticed this on here, but I think it's worth mentioning. If you look here, we were up by 6.9% in the S&P 500, back ending on 827. Let me remind you of what 827 was. 827 was the reporting of the economic metrics of our country after the first round of stimulus got pumped in. But we also at that point had the belief that there was going to be a second round of stimulus when Congress got back from vacation on September 8th. So you can see how much that does affect the stock market. And again, as you know, you've probably been reading, watching news, it's everywhere now, that failed. And now you can see what that failure has done to the results of the belief of the stock market in the short term. So what are the actions that we can take right now? Well, I've talked about the paradigm shift in where our money should be invested. Now, we have changed our internal portfolios 4 times since March, and we are now on track. We have the portfolio exactly where we want it because it's based upon where people are spending money. Are they spending money in stores or online? Online. Are people moving to the suburbs or staying in the cities? They're moving to the suburbs. These are the kinds of things that you have to change when people, economies, civilizations change. You got to change with it. You could be one of those old buy and hold investors, and no matter what, we're going to buy Betamax, and then VHS took over, right? And then you were going to buy CD-ROMs, and then Blu-ray took over, and then you were going to buy Blu-ray, but then streaming happened. So what I'm saying is, in the world of investments, the old just buy and hold does not always work. I'm not saying day trade. I'm not saying try to figure out short term, but it's not too hard to sit down and map out where people are spending money, where people are moving, where jobs are trending. And that's where we put the money ahead of where it's actually going. Okay, so again, if you have not done this, if you're with us, we've already done it for you. If you've not already done this, this is something I would highly suggest doing. Sell real estate now. It's funny because people ask me, well, what are you doing? Well, we're putting our house up for sale. We'll rent for a year. We've done this before. We sold all of our real estate back in 2007, and we rented for almost 3 years, 2.5, 3 years. And we waited until the timing was right. But we have now again, everybody's different. Julie and I don't mind just hiring movers to come in and flip it and, make some money along the way, but everybody's not like that. Maybe they're rooted and they don't like to move. But if you have real estate and you have the possibility of real estate, a flip, now's a good time to do it. Consider TIPS, Treasury Inflation Protected Securities, as an alternative to short-term cash or holdings. Reverse mortgages, again, I know a lot of the pushback is the big upfront closing costs, but again, there's some positives to that closing cost because it covers negative equity upon the payoff of the reverse mortgage. And considering interest rates right now in reverse mortgages are only about 2%, it's a great source of money to either invest elsewhere, buy other real estate, pay off debts. It's just today, if you're eligible for a reverse mortgage, I would highly prepare you look into that. Prepare for a real estate purchase next summer. And again, a reverse mortgage might be a way to do that, or just lining up what you're doing with your real estate. Pay back any accelerated RMDs or 401ks because the CARES Act changed their tune about 3 months into the virus. And those people who took out accelerated withdrawals, you might have to pay it back. Otherwise, you will be responsible for a penalty. This I've been talking about. Prepare for even more massive election volatility. By the next time that I talk to you on this broadcast, hopefully we'll know who the president is, and then we can start mapping out what the strategies will be. Right now, we just have no idea. We can't trust the polls, as we learned from 2016. Make sure you change your family trust. Again, depends on who gets elected. You might need to change your trust all over again. Reduce long-term bond holdings. Consider selling up. This means that if we have an election where Biden wins, we will not want to carry any unrecognized gains into 2021. Tax harvest and swap. If you have a tax harvest right now, that's an opportunity, I would take it. But worst case is you don't take it right now. Next year, you'll be able to use a tax harvest better if Biden wins. RMD and Roth conversions. And last, let me throw in here, I think it's a good action to analyze your annuities right now. Because if we see the kind of inflation that I'm anticipating, you're going to want to make sure that those caps are at least as high, if not a little bit higher, than what inflation is. Hey, to wrap it up, if you have not yet subscribed to our YouTube channel, you can do it one of two different ways. We have two channels. One is Wiser Retire or H&H Retirement Design and Management. And all you have to do is just Google. You could just say Wiser Retire channel on YouTube or H&H Retirement channel on YouTube. You'll find this little screen. And all you have to do is just hit the subscribe button, and now you'll be notified. The other advantage of doing this is I've talked to a lot of people over the last few weeks, kind of conveying our election protection strategy, and asked them if they are able to catch. And everybody says, well, you know, sometimes I'm busy on a Friday afternoon, but I like it because once I subscribe, I can just jump in here and I can grab whatever videos are rendered after your show, and I can watch them at any time. Hey, lastly, thanks for joining me today. Hopefully this information is helping you understand not only what's going on with this crazy economy, election, virus, economic downturn, all these just anomalies of life that none of us in this generation have ever experienced. But I want to make sure that if you've got some questions, you can feel free to reach out to us. The phone number here is 844-702